These 5 monopoly stock rule India. Do you know which one they are? Coal India Limited. Coal India Limited is often referred to as a monopoly stock because it is the largest coal produced in India, supplying about 70% of the country's coal. The dominant position gives it significant control over the market, making it a monopoly. The Indian government holds a 63% share in Coal India Limited. Market capital 2,42,596 crore. PE ratio 6.74. Dividend yield 6.48%. ROE 52%. ROC is 63.6%. Debt equity ratio almost debt free, meaning its debt equity ratio is extremely low. It is almost free of debt. The stock gives a good dividend yield of 6.48%. The company has a strong record of return on equity, which is 52.8% over the last 3 years. The company pays out 49.8% of its profit as dividend, which is healthy. IRCTC. IRCTC is considered a monopoly stock because it holds exclusive right to online railway ticket booking, catering services, and packaging drinking water services for Indian Railways. This monopoly position means that no other companies compete with IRCTC in these specific service areas. The Government of India holds 62.40% of the share in IRCTC. Market capital 63,704 crore. PE ratio 6.74. Dividend yield 6.48%. ROE 52%. ROCE 63.6%. Debt to equity ratio. IRCTC is almost debt free. The company has lower to debt. It is almost free of debt. The company has achieved a profit growth of 32.2% per year on average over the last 5 years. It has a good return on equity of 41.9% over the past 3 years. The company pays out 44.3% of its profit as dividend, which is healthy. Hindustan Aeronautics Limited. Hindustan Aeronautics Limited (HAL) is referred to as a monopoly stock because it holds an exclusive contract with the Government of India, making it a dominant player in the country's defense sector. This results in less competition in the market and solidifies its strategic importance and leadership position. The Government of India holds 71.64% of the share in HAL. Market capital 2,81,287 crore. PE ratio 33.2. Dividend yield 0.83%. ROE 28.90%. ROCE 38.90%. Debt to equity ratio almost debt free. The company has cut down its debt. It is almost free of debt. The company has achieved a profit growth of 26.5% per year on average over the last 5 years. It has a solid return on equity of 28.4% over the past 3 years. The company pays out 29.6% of its profit as dividend, which is healthy. The company's working capital needs have decreased from 62.2 days to 37.1 days. Nestle India. Nestle India is often referred to as a monopoly stock because it holds a significant and dominant position in the Indian food and beverage market. This strong market presence allows it to exercise substantial control over its segment. Market capital 2,15,267 crore. PE ratio 67.80. Dividend yield 0.69%. ROE 135%. ROCE 169%. Debt to equity ratio almost debt free. The company is nearly debt free. It has achieved a profit growth of 19.6% per year on average over the last 5 years. The company has a very high return on equity of 121% over the past 3 years. It pays out 86.2% of its profit as dividend, which is healthy. Pidilite Industries. Pidilite Industries is considered a monopoly stock because it is a dominant player in the adhesive and sealant market. It faces very little competition in this segment. Market capital 1,49,153 crore. PE ratio 76 only. Dividend yield 0.5%. ROE 22.80%. ROCE 29.70%. And debt to equity ratio almost debt free. It is almost free of debt. It pays out 44.4% of its profit as dividend, which is good. The company's working capital needs have dropped from 41.8 days to 24.3 days.